Hello, and welcome back to episode 2 of the Retire in BC podcast. I'm Arnold, joined by my co-host Ben. Today we're going to be talking about the 3 pillars of retirement income and how to use them to connect the dots between where you are today and where you want to be in retirement.
Yeah, that's right. So these pillars, that would be government programs, workplace pensions, and also your personal savings, they're the foundation of a solid retirement plan. But the thing is, not everyone has all 3 of them. If you're missing one, you kind of have to rely more on the other 2. And so it's really just something that you want to get a handle on going into retirement. Bit of a balancing act. And yeah, we're just hoping to break those down a little bit more in this episode. So yeah, we're going to start with the government plans, that first one. Arnold, yeah, why don't you launch into that a little bit?
Yeah, sure. I like to tell clients, we have this discussion quite often. Really, government plans, you kind of break them down into two core ones. There are some other ancillary plans, but really there's 2 core ones. There's CPP and there's old age security. And we'll talk a little bit more in detail about each one of those. But CPP is based on how much you put in. And
What does that
so
stand for, Arnold? CPP?
the Canada Pension Plan, that's how much you put in, based on how much you put in. And old age security's got nothing to do. Oh, so CPP and OAS, old age security, has nothing to do with your earnings, with how much you've put in. It's simply how long you've lived here. And if you've lived in Canada for more than 40 years, you get the full amount. If you've lived in Canada for more than 30, but not quite 40, you'll only get 3/4. And similarly, half or a quarter. But for most of us here who've lived here all of our life, we'll get the full amount. None of them is a ton of money. All of them are only meant to provide a small amount of our retirement income, but they aren't insignificant either. They are meaningful.
Yeah, well, that's kind of it. And starting with Canada Pension Plan, CPP, really, they didn't put that together willy-nilly. They had an idea of how much it should provide for you in retirement. When it was originally introduced, the idea was that up to a certain amount, you're depositing money into it. Everyone is as they work. And up to that amount, the intent was for it to provide 1/4 of that amount of income in somebody's retirement. Since then, it's actually been enhanced more recently. We'll get into that in a second. But that limit that I was talking about, that's something called the year's maximum pensionable earnings amount. So basically the YMPE. Basically, if you're earning up to that amount, both you and your employer remit a little bit of your paycheck to the Canada Pension Plan. The year's maximum pensionable earnings amount for 2025, that's about 71,300, or it is exactly that amount for that year. So basically, under that, if you've been earning the YMPE, basically that amount adjusted for inflation your whole life or your whole career, in retirement, for that to provide 1/4 of your income, what you're used to, like Arnold said, that's not insignificant. That is one of the major sources actually of income in retirement. If you've been earning higher than that amount, well, on those additional dollars, you haven't been contributing anything to Canada Pension Plan. So for someone who's been earning way, way more than that, to them, the amount that they get out of CPP, it's nowhere near 1/4 of their earnings. It's a lot less than that. And yeah, like I mentioned, actually more recently, they've been enhancing the program. So in 2019, they announced some enhancements to the Canada Pension Plan, both by increasing basically the amount that people are putting in. And also they announced this new thing called CPP2. We don't really need to get into it. I don't know why they didn't just merge those into one thing, but if you're earning above that initial limit, you might see CPP2 deductions on your paycheck. It's basically the same thing. It's just a little bit more, an additional amount. The intent there is to end up getting to, rather than 1/4 of your income replaced in retirement, to get to 1/3 of that income.
So Ben, you may not be aware of this, and actually, I've never fact checked this, so I don't even know if this is true. But I heard ages ago that when they first implemented CPP, the first year at which you could collect it was actually later than the average life expectancy. So they weren't planning to spend a lot of money in CPP. And in fact, and this I have fact checked, in the past, the CPP was actually a bit of a, well, Ponzi scheme isn't maybe the right term, but it was sort of like that. It wasn't a normal pension plan. Money was not set aside for that pension. What happened instead was the government, just out of year-to-year revenues, paid for the pensioners. And so a question that I still get today quite often is CPP going to be around for me when I retire? And fortunately, when the prior to the government making some of the enhancements Ben was just talking about, they made some really good moves to make it more like a real pension. And in fact, today it really is. There's the Canada Pension Plan Board that oversees that. They have that money set aside. It's invested. An actuary looks at it every, I believe, 3 years, just like other pension plans. And so it is definitely going to be there for those of us when we hit 60, 65, 70, whatever year we want to collect it. The normal year is 65.
Yeah, no, that's totally true. And I think it's a little bit of just a misconception, and it's probably because that's how it works in the States, and people just kind of take that on. Social Security, it's like you say, it just comes out of general revenue. There's no
That's right.
fund set aside for it. Basically, people earning and paying taxes today are responsible for paying those Social Security checks going out. Um, Canada Pension Plan, by contrast, is actually an extremely well-run fund.
It really is, yeah.
Yeah, we touched on this last time, but sort of I've recently gone through the CFA program, and one of the things that we talk about in there in quite some depth is actually institutional money management. So basically, how do big institutions, whether it's a sovereign wealth fund or an endowment or a charity, how do they manage these billions and billions, or in some cases, trillions of dollars? And really, the three models we looked the most at were the Norway model, the Yale model, and the Canada model. So the Canada pension plan is well run enough to the point that it's basically a beacon to the rest of the world that this is a really good way to invest your money. We don't need to get too into the weeds of how Canada Pension Plan is actually investing that money, maybe in a future episode. But yeah, no, it's very well run, more than 100% funded, meaning that with some assumptions, they have to make some assumptions to get to this number, but they think that if they had no further contributions whatsoever, they could meet their current obligations moving forward. So.
Well, no, but for how long? Like not forever.
Well, the obligations that currently exist, right? If
I
you
get you.
stopped
Okay.
all
Yes.
contributions and
Yes.
all
Okay.
obligations moving
Right.
forward,
Right. Right. Yeah.
those are
So
funded.
fully funded. Yeah.
Fully
Yeah.
funded,
That's yeah,
exactly. Yeah.
exactly. So the if you have contributed to the CPP and to that maximum level, which like Ben said earlier, for 2025, if you were to earn 71,300, that would be the maximum level. If that's been consistent for 39 years for most of your life, you will get the maximum CPP, and currently that's $1,365 per month. Um, and and that is like old age security. It is fully indexed to inflation. So it's going to keep going up. And most people don't get that full amount. The average is just $815, but you can sense it a little bit by just looking at what your contributions have been in the past. And in fact, you can go to Service Canada and ask them with a few mouse clicks, or you can make a phone call, but with a few mouse clicks, you can actually get a report showing your contributions going in, and also get that estimate of what they think your CPP is going to be.
Yeah, and so if you want to do that, you want to Google My Service Canada. That's the right spot to go and log in, basically to the government website, and it'll tell you those numbers that it kicks out, and the numbers Arnold just gave too, that the maximum amount is 1365 monthly. those are based on if you take it at age
Oh, yeah,
65,
good point, Ben. Yeah, that's right.
right? Which is probably the most common, which, but you do have the option, actually. You have the option of both taking it earlier, as early as age 60, or delaying it until age 70. But I mean, with some trade-offs there, if you take it early, you're going to get a lower amount, but for more years. If you take it later, then you get a larger amount, but for fewer years because you have fewer years left alive. And basically that increase or decrease, that's based on a monthly amount. So basically if you start early, your payment decreases by it's 0.6% per month. So on a full year, that's 7.2% less that you get for each year early that you've taken it. So just sort of the way that math works out, if you take it 5 years early, you earn 36% less than if
Right.
you had taken it at 65. Going up, it's 0.7% per month or 8.4 per year. So if you delay for 5 years, it's actually a 42% increase in your benefits, which is pretty huge. But again, then you're getting it for 5 fewer years of life.
Well, and actually, the math that I've done every time, the net present value of future cash flows suggests that if you have an average life expectancy, you're actually better off delaying it to age 70. Um, but what isn't factored in there is your own personal experience, your own personal life expectancy. It may be different than the average life expectancy. What's also not factored into there is your unique tax circumstances. So that's why we usually say don't just guess. Come talk to us, talk to another financial planner. Weave this in among your other retirement income plans and make sure you're getting the best bang for the buck on it.
Yeah, yeah, for sure. Yeah, that's probably enough about Canada Pension Plan for now. Yeah, I mean, the gist of it is that you pay into it while you're working. Actually, I guess one thing before we move on that we didn't chat about, there are some provisions. We talked about having to work for 39 years in Canada to get that maximum benefit. There are a couple of provisions, like if you were raising children. I believe it's if you're raising kids under 7, basically those years don't count towards that 39-year income earning threshold that they're looking at. So basically, if you spend 10 years raising kids that are young instead of working, well, then the government's only looking at your highest 29 years of income rather than your highest 39.
Yeah, basically they don't count those bad income years against you, which is good. One other thing that I think it's worthwhile mentioning, CPP's not for free. Like you're paying for it. You're paying almost 6%, 5.95% of your income. You'll see that, when you see the pay, on a payroll deduction. But what you don't see, or at least not usually, is your boss is also paying that same 6%, 5.95%. And then, for those of us who are self-employed, we're paying both sides of it. So it's not for nothing. You're paying for it. You deserve that money. You really do. And just like a real pension, people putting into it, ultimately they're getting out. So don't ever feel like you shouldn't collect it. I know some elderly people feel a bit sometimes that way, but you're owed it. You put the money in, you deserve it.
Yeah, so moving on to old age security. This one, where Canada Pension Plan was based on your earnings and based on working in Canada, old age security is just based on how long you've lived in Canada,
That's right. Yeah.
right? Well, and also on your age, obviously. Old age, I can't collect it. I'm 31 years old. Woe is me. But basically, if you've lived in Canada more than 10 years, you're eligible for some old age security. If you've lived in Canada for more than 40 years after the age of 18, then you'd be eligible for the full amount of old age security. That amount, the maximum is 713 a month. Again, that's based on being at age 65
And having been here for 40 years. Yeah.
and having been
Yeah.
here for 40
Yeah.
years. Yeah,
Yeah.
exactly. And then that one too, I mean, there are modifiers up or down. OAS, you can't take early, you can only delay. right? So 65 is the earliest. And again, you can delay this one. Yeah, again, 0.6% per month of an increase for every month that you delay. So 7.2% per year. Other than that, there's also separately, after you hit age 75, they bump up your old age security payment by 10%. Okay.
Yeah,
Uh,
actually, one other thing that can confuse some people, a number of years ago, the government actually changed the base age from 65 up to 67 for both CPP and OAS. And then I believe actually it was the Trudeau government um, reverted back to age 65. Uh, what's interesting is many countries in Europe have gone to the age 67 model because we all are tending to live longer. In fact, it's my opinion they should actually. I think Canada should bump it up to 67, but they haven't. They've brought it back down to 65. I wouldn't be surprised if at some point in our lifetime they didn't push it up a little bit because we do seem to see that happening around the world. But where it's at right now is that age 65. And similar to CPP, the math sort of favors all things being equal, delaying it to 70 if you can.
I mean, it tends to. That does depend a little bit, again, on the tax situation, on your
Exactly.
other earnings. Old age security specifically, it has, if you're earning too much, there's a clawback. It's actually not called the clawback, it's called the recovery tax. But yeah, where Canada Pension Plan doesn't have that. But old age security, basically, if you're earning over the threshold, they will start to claw back 15% for every dollar over that threshold you are of your payments. Um, so those numbers, those are actually mid-year, but basically from July of 2024 to June of 2025 for the income year. Basically, that minimum threshold is 86,912, and then you'd be fully clawed back at 142,609. You wouldn't get any old age security.
Yeah, I think the way that I think of it, the way I encourage people to think about it is think about it like a 15% additional tax. In addition to whatever your tax bracket is, it's an extra 15% within that band, right? So, 85 to 90 grand, all of a sudden you're getting hit with this extra automatic 15% tax. So if it's possible, you do want to try to coordinate your income so that it's below that. Or or you have a big hit one year and it gets clawed back fully for a year and then you get it again. That can be more favorable than constantly being in it. But again, that's you kind of need the help of an advisor. I guess if you're an accountant, maybe you could try to do it yourself, but it does get a little bit complicated.
Yeah, yeah. Well, and that's kind of the story of all of these. We'll give a general amount for how much is out
Yeah,
there, and then
yeah,
there are any number of modifiers up or down
that's it.
in
That's
terms
it.
of the income you receive, and then
Yeah,
that
yeah,
informs what you should do. So yeah,
yeah,
it can be
yeah.
a bit complicated. So that's kind of the old age security clawback thing. On the other side of things, if you're much lower income, there is one other basically government program there called the Guaranteed Income Supplement. Basically, that's GIS for basically yeah lower income retirees. And that one again, it's just a little bit different based on a couple of different circumstances. It's different whether you're single or if you're married. And if you are receiving old age security or if your spouse is receiving old age security, sort of how much you get there. Well, you have to be getting OAS to get GIS in the first place, but there are some dependencies on your spouse, basically.
It's an insanely complicated formula. The best thing to do is to go to the tables and look it up. They give you, I think it's 6 or 8 different tables depending on your unique situation, and then you enter in your income. But the crazy thing is, you enter in your income excluding your OAS income, and because that's not factored into the GIS. So it is, but long story short, if you're of a lower income, there is an additional benefit there that's available.
Yeah, well, and just to give some context, I'll give the simplest case, which is someone who's single, widowed, or divorced, and they're receiving old age security. Basically, the income threshold is $22,056. That's for the 2024 year. We're filming this in December of 2024. And basically, if your income's below that, the maximum payment amount is $1,087, basically.
And I think that's income excluding OAS.
Yeah,
Yeah, yeah,
yeah.
yeah.
So,
So, and the great thing about every single one of these, we mentioned it before, but we'll just highlight it. The great thing about every single one of these is they are fully indexed to inflation, which over the course of your lifetime, inflation is going to eat, if you have a fixed income, it's going to eat into your income by a massive amount over your lifetime. Just 2 or 3% really creeps up. Doesn't look like it year by year, but at the end of a lot of years, it's really a lot. So it's wonderful that these are all indexed to inflation, and they do, each one of them lasts until the end of your life. In fact, some of them actually extend beyond to your spouse partially after you pass away.
yeah, which is a huge deal because I mean it's one of the hardest things when it comes to the retirement planning is we can talk about how much income you want during a retirement, but if we're trying to plan out throughout the lifetime, well, how long is the lifetime going to be? Right?
Yeah, yeah.
We don't know exactly, and so to have these benefits that just go in perpetuity is a pretty big part of it.
And actually, the other thing I should mention, and I don't think we've ever talked about this, Ben, but my experience has been my clients, when they get really elderly, their spending drops off a cliff. Their need for income, I mean, aside from going into assisted living or long-term care, but even there, then often the government's kicking in or capping how much you have to pay. But generally, people spend a lot less. And what I've tended to see, and again, everybody's different, but what I've tended to see is as people approach the really later years of their life, they're not spending more than these government programs. And so again, the fact that that's going to last your whole life, really it's going to keep you housed and keep you fed for most people. For most
Yeah,
people.
yeah. Yeah, and I mean that's maybe a good tie-in to what we're going to talk about next, which is the moving beyond government plans and into employer-sponsored plans, is that's really the key differentiator between the two kinds of work-sponsored plans, is basically you can have one of several types, but really the two big ones are defined benefit pension plans and defined contribution pension plans. And so, really, with a defined benefit pension plan, that's where your employer is responsible for basically the investment decisions and the outcomes. And if you have one of these kinds of pensions, you'll get a statement that says, okay, at age 65, I will get X dollars per month going forward. And if I retire early, I might get this bridge benefit, just meaning additional payments until you hit 65 and start these government programs. And so basically, you don't see an invested dollar amount. You see, this is what I will get
Right.
monthly in retirement. By contrast, you can have the defined contribution pension plan, which is one where the employer just says, you know what, we're dumping this much money in off your paycheck. You go, manage it yourself. They'll have a sponsor that you're limited to a certain amount of investments, but basically you're then responsible for the investment and for how well it does. And it doesn't give you a monthly figure. It just gives you a dollar amount on your statement, basically.
Well, and those can be confusing terms, defined benefit and defined contribution. And if you don't remember them, you can easily be forgiven. Go and ask 10 I hate to disparage our industry, but go and ask 10 financial advisors or investment guys what's the difference between a defined benefit and a defined contribution, and they're not going to know which is which, half of them. But there is actually a very simple way to remember it. If you have a defined benefit plan, you know what your benefit is defined. You know what you're going to get down the road. You don't know what you have now, but you know what you're going to get down the road. If you have a defined contribution plan, your contribution is defined. You know how much, just like an RSP, you know how much you're adding every single month or every single paycheck in most cases. And in fact, often what you'll see is your contributions, and you'll see your your employer's contribution, and those are defined. But you don't know what your benefit is going to be, because it's just like an RSP. It's going up and down. It's being invested, but what you're putting in, your contributions are clearly defined. You can see them right there. And that's a very simple way to remember what the difference between the two are. We've certainly seen a huge reduction in defined benefit plans. Um, Union employees and well, government workers, um, pretty much. I mean, that's the vast majority of them. Just about everybody else has gone to defined contribution plans because it takes the risk off the employer.
Yeah, no, I mean that's definitely true. It's anytime I'm sitting down with someone who's a teacher or a nurse or an RCMP officer
Yeah.
or things like that, they've got usually a pretty great defined benefit pension plan. Most everybody else, if they have a work plan at all, it's usually a defined contribution pension plan, which is still, yeah, great, but not quite the same.
Now, do you know, actually, there's a couple of reasons that defined benefit plans have been going by the wayside. Definitely, the biggest one is de-risking by employers. But in my opinion, I've seen a few legal cases where employers. So I don't want to get too technical here, but every 3 years, a defined benefit plan has to have an actuary review it, just like we were talking about with CPP before. They have to have an actuary review it and say, okay, what you're going to have to pay out is X. What you have is Y. You're short or you're ahead, depending on how your investments have done. And the actuaries will give them um, this plus or minus, and if they're out by too much, either way, like if they're short by too much, they have to make extra contributions. If they're just short by a little bit, it's assumed that markets are going to do better. There's a bit of an allowance there for market movement, for those employers. But if it's significant, they've got to make up extra contributions. There have been a few high profile cases where, when there's been an excess, what's happened is the unions have gone in and said, we want that excess, or actually, we want that excess for our employees. And so employers have actually taken on the risk if it's not enough, but they don't get the benefit if it's too much. And so when you're in a position where you're not going to benefit from taking the risk, but you are taking a risk, you're even less likely to adopt those plans. In my opinion, that's actually been a huge contributor to the decline of these plans, unfortunately.
Yeah, I mean, it's also just intuitive as well, in that if you're an employer, would you rather A, deposit money on someone's behalf and then forget about it, or B, but be on the hook
Right.
for their entire retirement and the entire retirement of your entire workforce, have to maintain those payouts on a set schedule, oftentimes indexed to inflation. You have to invest and be on the hook for it. And so,
Right.
yeah, it's not too surprising to
Yeah.
me that those are falling a little bit down that way. On that note, too, on the indexing to inflation, most times that I see a defined benefit plan, they are indexed to inflation. There's a cost of living adjustment to them, but it's something you want to watch out for because they don't all have
Yeah,
that.
lots of times they're not, but
Lots of
you're
times
right.
they're
Most of the
not.
big government plans do.
Most of
Yeah.
them do. And even if they do usually have a cost of living adjustment in extreme situations, they're usually not
Yeah.
totally
Yeah.
obligated to do that. Now, it would be a pretty big news story, I think, if the RCMP pension
Right.
was, we'd see it coming a mile away that this pension plan is starting to be underfunded and they might have to start making adjustments like that. But yeah, usually there is that provision for
Yeah. Yeah.
something like that.
And by the way, that underfunding is a real thing, I actually had a case, oh man, this was probably going back about 15 years ago, where a client wanted to pull all their money. They had quit their job. They wanted to pull all their money out of their pension. And they had the option of taking an equivalent value of this defined benefit pension, but it was underfunded. And the pension provider gave us 90% of the money and said, actually, they gave us 89% of the money. I remember this. It was 89% of the money. And they said, come back to us in 5 years and we'll probably have the other 11 for you. And it like we basically had to keep track of this 5 years down the road.
Wow.
We submitted a transfer for the rest of the 11%, and we got it. We got it. But yeah, no, it was so the underfunding is a real thing. If a pension plan is underfunded, it is at risk. If the employer were to go bankrupt at that time, the what's there would still belong to the employees. But if it was underfunded, it would just be that lower amount, right? So it's
Yeah,
it's
yeah.
it's a definite real thing. I mean, not these days. These days, markets have been doing great, and so pensions are all doing very well. But when times aren't good, that underfunding can be a problem.
Yeah, yeah. Well, and so from that perspective too, I mean, even to the employee, their benefits then to going the other route maybe
Yeah,
and
that's
having
right.
the
Yeah, you've got
contribution.
control then. Yeah,
You've got control. When you leave the employer, you can usually take it with you. That'll be transferred because it's come from a pension plan. It ends up being transferred into another locked-in plan. Basically, it's usually a locked-in version of an RSP
that's
that
right.
basically you just can't withdraw it. It's intended to function like a pension plan. Usually you can withdraw it after your age 50 or age 55, depending on the province. And so just sort of think of it like an RSP, but with a few additional rules in terms of how you can access the money.
So employers also, I mean, the two main ones in the past were these two different pension plans, but employers can also offer group RSPs. They can offer profit sharing plans. Group RSPs, actually, particularly group RSPs, can look a lot like those defined contribution plans. In fact, in my head, I tend to equate the two. Both of them, basically, you've got a dollar amount you're contributing and your employer is contributing usually a percentage as well. Um, uh, yeah, and you talked about transferring, changing jobs. You can usually often you can transfer pensions either kind from one company to another, if it's part of the same pension group. Like we've seen a lot of um, medical workers switch from one medical authority to another medical authority, and they're able to just transfer their pension within. I've even seen some people that have switched quite significantly job positions, a completely different government body, and they've been able to port their pension. So there's a lot of that can happen, but it just depends on how flexible that specific pension is and what specific your job is. You never know for sure until you're actually doing it.
Yeah, yeah, yeah. Yeah, so I mean those are kind of the main ones are those defined contribution pension plans, defined benefit pension plans. Group RSPs are probably next up there. Then you've got deferred profit sharing plans. There
Yeah,
are
a
all
lot less
sorts
common.
of
Yeah.
a lot less common, but yeah, there are a few just different things out there. Really, those are the big ones that we've touched on here. But yeah, are sort of make up the second pillar. If you have these, great. If you don't, then you have to make up for it a lot more with your personal savings and sort of what's going on there. Um, in terms of those personal savings, so this is something that we're going to touch on today. We're going to talk about it more, I think, even in future episodes. Really, so far, we've been talking about those things that are in the background happening for you, whether you manage it or not too much. The personal savings, this is something that you need to take a much more active role in. So basically, we're going to talk about, next episode, sort of defining your retirement path. The episode after that, delve much deeper into this personal savings kind of thing. But just sort of some ballpark numbers here. Usually, I'm recommending, if you can save, ideally 20% of your net income. That's usually a really good spot to be in. 10% is also good. Most people aren't even hitting that. I think the average in Canada is like 4.5%.
Yeah, it's something like that. Yeah, you read the old book Wealthy Barber, he says at least 10%. Um, for those of you who are a little bit older and can remember John Templeton, there was a fund company out there called the Templeton Funds. And I heard Sir John Templeton speak once, and I remember he got his start in the investment industry by saving 50% of his income. And a lot of times people tell me I can't save money. There's no way I can afford to save money. You go through the spending, and very seldom is that actually true. I would bet, no matter who you are, whoever's listening to this, break it down what you are actually spending your money on. I could find you some savings if you can't find it. You may or may not be able to get up to 10 or to 20%, but you probably can save more, and that's, a valuable thing to do. For most people, it's necessary.
Yeah, yeah. And I mean, at the end of the day, it comes down to priorities and what you're willing to sacrifice to get, here or there.
Exactly, yeah.
Um, we'll probably also do a future episode more on the budgeting side of things and what you can do there. But yeah, I mean, I personally still rent a house. I have three roommates because I prioritize the savings of income. Would love to change that around, but for now, just really want to bump up those savings as much as possible because I'm self-employed and I don't have a work pension plan, right?
Right,
So,
right, yeah,
so
yeah.
that was actually one aspect I wanted to talk about is that this, save to 10 to 20%, really that does depend a lot on what we had just been talking about. Sometimes we are meeting with people who they're planning to work until age 70, and by the time they delay CPP and old age security, and they have their amazing RCMP work pension, and sometimes they're double dipping on pension. I've run into cases where people's fixed pension income for life, inflation adjusted, exceeds that they were earning when they were working. So, still would probably be a good idea to set some money aside and just have it liquid, have that, available to do other things with. But really, it is sort of a judgment call on that amount. Typically, what we're trying to achieve with this is okay, with all of those sources together, most of the time you're aiming to spend in retirement between 70% to 100% of what you were spending while you were working. And in some cases, I mean, this is all variable. Some cases, even more. People retire at whenever they retire and they want to travel the world for the next 5 or 10 years and spend way more than they ever did while working.
Yeah, actually, I've seen that lots of times where people their need for income in retirement is higher, and I've also seen less than 70%. Actually, it really it varies so much, but it is true. Most people are in that 70 to 90, 70 to 100% range. Yeah, yeah, and we've got lots of savings vehicles available to us today. RSPs, TFSAs, first home savings accounts, our ESPs. Some of those are single purpose or purpose driven savings accounts. But you know, for most of us in high tax brackets, RSPs are the better deal. Lower tax brackets, TFSAs are the better deal. Once you've capped those out, you can just invest. It doesn't have to be in those types of accounts. Those have some special tax benefits, but lots and lots of places that you can do it. Again, we can get into that in a lot more detail in some future episodes.
Yeah, yeah. And I mean, when we say invest, usually, you're going to be working typically on the younger side of things. You're going to be invested a little bit more aggressively, more in the equity side of things. These are things that you need to make sure you're comfortable with ups and downs and sort of educated on what all of that means. But yeah, oftentimes you're investing aggressively early, oftentimes in a tax-free savings account. As you approach retirement, we're toning that down a little bit just because you don't want to retire one year and then 6 months later the market crashes and you were 100% in equities and that
There used
probably
to be
not.
this, yeah, yeah. There used to be
Sorry, go
this
ahead.
rule of thumb that you had 100 minus your age in a bond portfolio. And I hated actually that math. Because to me, it just there's an element of truth to it. As you get older, you should have a greater weight to bonds. But frankly, in my opinion, if you've got any kind of a runway before you're going to need to pull that money out, being mostly equity, if you can stomach the ups and downs, and I don't think they're that bad to stomach, but it does take a little bit of getting used to. You're best off with all equity or close to all equity, right? But again, that's something that you need to walk through with a professional and make sure that you're in exactly the right spot for you.
For sure, yeah. And yeah, so I mean, on that note, next episode basically is we are going to be chatting about defining that retirement vision, how you want it to look, how much money you're going to need to have, all that stuff. And then the following episode, we'll get into a little bit more detail on the personal savings that you need to cover the shortfall here and get yourself from point A to point B.
Yeah, right on. So thanks for joining us for today's episode of the Retire in BC podcast. We've unpacked the three pillars of retirement planning: government benefits, workplace pensions, and personal savings. If you found this episode helpful, please like it, share it with others. Retirement planning can seem overwhelming, but it doesn't have to be that difficult. It's a lot easier when you have the right information and the support of people like us.
Yeah, absolutely. Yeah, and if you'd like to discuss your specific retirement situation, visit our website, visionvest.ca, and click Start a Conversation. Next time, we're going to focus on creating your retirement roadmap, which is how to connect the dots between where you are today and where you want to be in the future. Yeah, looking forward to it. Thanks for tuning in. See you then. The views and opinions expressed in this podcast may not necessarily reflect those of IPC Securities Corporation or IPC Investment Corporation. The information provided is for informational and entertainment purposes only and should not be construed as financial, legal, or tax advice. The hosts and creators of this podcast assume no liability for actions taken based on the content discussed.